Are you looking for valuable business advice to reach that 7-figure revenue mark? Do you want actionable tips to properly navigate through every business challenge you encounter along the way? Let Tersh Blissett and Josh Crouch be your guide in getting you to the top here at Service Business Mastery. Tune in as they sit down with world-renowned authors in business, leadership, and personal growth who share valuable insights about management, marketing, pricing, human resources, and so much more. Let their nuggets of wisdom gold guide you in owning a thriving, profitable, and ever-growing business. Here are your hosts, Tersh and Josh.
Hello, everyone out there in podcast world. I hope you're having a wonderful day. You are listening to or watching the Service Business Mastery podcast. I'm your host, Tersh Blissett. Today, we have Brandon Bolin on. He's with Live Oak Bank, but you've probably heard his name, especially whenever we're talking like with Patrick and last week on the live, and his episode will actually be released here shortly. Patrick does a lot with businesses selling and buying, and his go-to man every time whenever you talk to him is Brandon, because of the just the diligent hard work Brandon does for their clients. And anytime you talk about business acquisition, Brandon's name kind of gets brought up almost instantly, and it's wild whenever I'm talking to people and you say, yeah, Brandon was Live Oak, and they're like, oh yeah, I know Brandon. I know who Brandon is. And then anytime you start talking business acquisition in the service industry, everybody seems to know Brandon. But today's episode is for those people who don't know Brandon and they don't know what all of that is they offer, but also it's not just whenever we're talking business to business buying and selling. You know, there's a few other times whenever you would reach out to somebody like Brandon. And so that's what we're going to talk about today on today's show. With that being said, welcome to the show, Brandon.
Thanks, Tersh. Happy to be here. Looking forward to kind of educating your listeners on SBA loans, who Live Oak Bank is. And I know the hot topic is business acquisitions, because that's how a lot of people are looking to expand and getting value that way and meeting their growth goals. But there can be a little bit more to banking and what we can provide financing for. So,
absolutely. Tell us a little bit about Live Oak and then yourself too.
Absolutely. So I've personally worked at Live Oak for about 6 years. Been lending to home service companies for almost 3 years now. But we're really, I normally say unique, but I'll say we're weird as a bank. Because most banks will essentially get a bunch of bank branches, they'll set them up in a specific geographic area, and they'll kind of lend to consumers, homeowners, businesses alike, but with no real expertise in any one product or any one industry. So think, an inch deep, mile wide type thing, which is fine. It's worked. But when we were founded, maybe, 13 years ago, we took the exact opposite of that, where we have never made a consumer loan. We've never made a residential mortgage. And all we do is provide financing to small businesses in specific industries that we've researched really heavily, mainly using the SBA 7A loan product. We've kind of expanded into conventional offerings because a lot of our customers over the years have actually gotten bigger, where they've almost, an SBA loan was almost like a Goldilocks loan, right? You can't be too wealthy, because once you become too wealthy, the SBA, which is a government administered program, says, hey, you can get conventional financing. So we have a bunch of teams set up where we focus on specific industries. So our team here at the bank, all my teammates Dylan and Jordan do, is work with home service companies like your listeners. And even though we have one bank branch in Wilmington, North Carolina, we can lend in all 50 states because of our expertise or our specialization in your industry using just a handful of products. So unlike most lenders or most banks where they'll hop off a call and they're talking to a dentist or a car wash or an auto repair shop, all I'm doing is talking to heating and air and plumbing companies. And through the SBA program, most of what we're doing is, I'd say in our industry specifically, it's kind of split right down the middle. think, Brandon Bolin Heating and Air is looking to buy Tersh's HVAC, and Tersh wants $1 million for his company. Well, I probably don't have $1 million in cash, but a bank will provide me financing to grow that way. And that's what we do. Or, my company's looking to buy real estate because, I'm bursting at the seams and my landlord's a pain, and I'd rather own my building and build equity that way. And we can give you a commercial mortgage through the SBA loan program.
That's really awesome. And one other thing that I'd like to add is that whenever I reached out to you last year, time flies, but it was really cool. I mean, it's cool. And at the time it sucked, but at the time it was really also very helpful. Anybody that listened to last week's episode and the week before that, whenever we were talking to Elliot, it's wild because I didn't plan this. Elliot, he actually comes in and does the numbers on the back end, and then start talking to Patrick, and then now we're talking to you, the lender, and it was very cool when we talked before, because I just sent you my numbers and I sent you the data for the company that we were looking to purchase, and you're like, yeah, this doesn't really make sense, and here's why, blah 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 blah, and I was like, that sucks, but yeah, I get it. Like, I mean, it makes perfect sense. So it was one of those things where, like, you could have said, hey, here's the money, here's some money, but you're going to fail. Like you were very, very open book and helpful whenever it was like, okay, that company doesn't really make sense for you right now. And I was like, why not? And so we dug a little deeper, and then you're like, this, that, and the other, these numbers don't align, this doesn't make sense, and all that. And I was like, oh, okay, cool. So you saved me like months and probably years of heartache and stress. And then going back and talking to Patrick, he was like, yeah, and you were trying to solve a problem of employees, but those employees weren't the employees you wanted. And I'm like, yeah, you're right. But then my ego kind of got in the way, and your emotion. And I guess that's a good question for me to kind of go into is, how often do you see these types of or people like me reaching out to you and say that I really want to purchase this company, he's my competitor, I want to put him out of business, at the same time I want to acquire all his people, but then it's purely emotional because that company just doesn't make sense. Like, that company is not really worth half of what they're actually asking. Do you see that very often? And if you do, like, does it ever get really emotional? It's like, I really want this guy. Like, I want him out of business type stuff.
Yeah, no, I think it's from my perspective, it's really common. And what I like to say is, when I have to get my air conditioning unit replaced, I have no idea what goes into the technical side of it beyond what the technician or the salesman tells me, right? Absolutely. That's their level of expertise, and I'm not expected to know that. And when we're a bank and we're working in your specific industry, you know how to run a company, you know how to get guys to show up every day, you know how to provide good customer service. But oftentimes you don't know what a bank's thinking about, you don't know what a bank's looking at. And so as a banker, it's really easy because we are in one of the positions where you can tell, unfortunately, you can tell a customer no, but a lot of times it's because they just don't know, right? They've never been on the banking side. So they look at a company and say, okay, well, they have 1,000 maintenance agreements. I know I can do this. But when I look at that company, I can appreciate the maintenance agreements, but what I look at is profitability, right? Yeah. And if your seller across the street who's doing $1 million in sales and wants $20 million for his company, Patrick will tell you that that's probably not based in reality. Yeah. And then I'll tell you, if I give you a loan, day one, you're going to default on the loan, which is not in our interest as a bank, but it's also not in your interest as a business owner, right? Because you have to personally guarantee there's going to be a lien on the business. And I'm not a commission-based sales guy, so I'm not going to be slinging like loans out the door that I don't think are going to, work. And I'll tell you why, because ultimately what that does is it paints a target for you as the business owner who stepped out along a limb. You reached out to a bank to see if something can be done. And my job is now to provide you a target and say, okay, hey, this is why we can't do the deal. So then going forward, maybe you tell the business owner it's not worth $20 million, but I'll give you $200,000. Yeah. And he's like, deal. And then we can do it. Or it's maybe he can't agree to it. But what it does is it provides you a target of, as you're looking for new businesses to acquire, you know what's within reason, you know what the bank can do, and ultimately it leads to a deal getting done versus me just saying, hey, we can't do this, and I don't even tell you why. That doesn't help anybody.
Yeah. And that was awesome whenever you and I spoke, because I had just acquired the business. Our books were just really goofy. Like it was not an ideal situation. And it was really rushed on my end too, because it was one of those things where it was like, all right, this company's coming up for sale. Let's like hurry up this process. And I was trying to get this stuff done, and you came back and you were like, hey, it's not a no forever. It's not right now, because you need to fix this, and this. And, that company needs to fix this, and this. And I was like, all right, cool. Gut check. But it's a good thing. Cause like for me, I'm one of those people where I would rather hear the hurtful truth than a comforting lie. And while it's not always pleasant and fun to hear that, but it's in the long run, it really does make a massive difference, because then turn right around a couple months later and we had a pandemic happen. And if that had happened while if I was struggling to pay a note, it would have been bad for both of us. It wouldn't have made sense for either one. Not that we could tell the future, but hindsight's 2020. And it really is one of those things where I'm just super thankful that it didn't go through. At the same time, it's like I learned a ton from that, even that short conversation that we had. And it was one of those things where it didn't cost me anything, but it could have cost me a lot had you just been, if you were like a commission sales guy and you just slung the note out, and then I was like, oh, like, hey, Brandon, what do I do now? And you're like, not my problem. See you later. Yeah.
And we've had customers in the past where they had taken out, because there are online lenders that will send you the money in a few days, but then they'll charge, really high interest rates, and you have to pay the loan back aggressively. And people will come to us to have us refinance those loans, right? Because an SBA loan is going to give you a longer term, so you have a longer time to repay it, and it's easier on the business. But when we review the financials, we were like, hey, this, net income's lower than where it needs to be. So that customer, had never even thought about that. They just thought you go ask a bank for a loan and they give it to you based on collateral. But we're, as an SBA lender, going to look at your cash flow. And first and foremost, we want the business to be able to repay the loan. And so I told him all this, and maybe 6 to 9 months later, he actually comes back to me and he's on the phone and he's like, I really listened to what you just had to say, started focusing on profitability, talked to my business coach. We, worked on it, and here's my financials. Financials looked great. And then he was like, but could you refinance the debt? And we're kind of talking. He's like, what? He's like, if I'm really a good student of yours, or not, nobody's a student, but if I've really listened to you, I probably shouldn't even take out a loan. I should just pay it off and not take out any debt. And even though we didn't get a loan out of it, it was kind of a proud moment for me to see somebody, turn their business around like that. And that's one of the cool things about being in our position, is getting to see a lot of financials for a lot of different businesses in the home services space. So we've definitely been exposed to all types of businesses.
That is awesome, though. Like the fact that, just what you mentioned there, that you get to see the financials of all kinds of service businesses. And it's like you said earlier, when you were first introducing, Live Oak, you're not looking at an ice cream shop and then an HVAC company and then, a pool company. Well, maybe you will, because a service company, something else, real estate company, you're looking at service companies, and so it's very consistent. So for me, I would like to associate this with air conditioning units, because most people that are listening are in the HVAC industry or plumbing and something. And you come up to an HVAC system and, it's a Rheem or it's a Trane or it's a Carrier, they're different brands, but you walk up on it and it's like, okay, well, this is what it should be doing. This is what it shouldn't be doing. But you're very familiar with the basics of how it should be operating. And I associate that with you, because Now, if we were working on an AC unit and then we went and worked on a windmill and then we went and worked on the other thing over here, and it's like, let me take a few minutes and figure out how to work on this microwave, but it's the same way with you. Like you're working on those service business financials. So then it's this is sticking way out. So we go to a compressor and it's making this howling noise. You're like, okay, that's a sore thumb sticking out. So you have that very quick sense of really just this is way off base type stuff. So with that being said, which is more important, top line revenue or net profit?
That's a great question. So from our perspective, from a bank's perspective, the most important thing is going to be net profit, because revenue is not going to repay the loan, but profitability will. So if I'm a company that's doing $1 million in sales and I'm netting $200,000 a year, that's the cash flow that I can either reinvest in the business or use to pay down a loan. If I'm looking to buy my real estate, you're going to qualify for, let's say, I don't know, a $1 million loan. Well, we're going to be willing to do that transaction. Whereas if you're a $2 million company in sales, from a looking at the outside looking in, that company's bigger. Yeah. But you're only netting 100,000 for whatever reason, you're going to qualify for less from our standpoint, because we're looking at your net income. So that's what's being used to repay the loan. Okay. So although we do look at trends, so trends are going to be important. We want to look at, if sales are stable or increasing. But ultimately, the cash flow of the business, that net income, is going to be what's used to repay the loan. So from our perspective, a company with a higher net income is going to be better. Now, it's going to have an easier time repaying the loan, but there are so many variables that can go into businesses, right? You might be somebody who's really growing your company. So you're really investing a lot in your marketing budget. So you might be investing more in direct mailers, and that's hitting your net income today. Yeah. But you're ultimately going to have larger larger sales.
How do we communicate that to you? Because I'm thinking to myself, like, whenever I was talking to you before about getting a loan, it was very last minute. It was not something that, hey, I plan on 3 years trying to purchase a company. It was super like, hey, this fell in my lap. Can I make it the purchase type thing? What happens if I come to you with that and my net profit's not where it needs to be, but I'm spending a ton in marketing because I really want to grow? And also, like, I just made some capital purchases. Like I purchased a backhoe that I really like. We just needed to purchase this. We could have rented it at the time. It seemed like the right thing to do. Now it's not, because I'm not renting. I mean, I have it on the books now. So like, can some of those things be taken into consideration? And if so, like, how, before I go and spend a bunch of money on marketing, before I go purchase another truck or two, like, how do I prepare in case something like this falls in my lap and it hurts my cash flow and net profit, but it's an investment? Like, basically, if I took that cash flow and net profit and was investing it back into the business already.
Yeah, those are great questions. So from the perspective of a backhoe, normally that'll be depreciated. So we will, when we review financials for business, we'll add back depreciation, because a lot of times those are for, you're not going to buy a backhoe every single year. Yeah. Right. So we'll add that back, and we actually say, okay, that goes into the big ball of cash or net operating income that can be used to repay a loan. So normally that comes out via financials, but things like marketing, or it's not uncommon for us to have people where they were heating and air only, and then in the middle of the year, they invested in upfront in a bunch of plumbing equipment and inventory and staffing and marketing for a new service line that hasn't yet, started getting the ball rolling, and they had to hire a plumbing manager. I can look at adding back those expenses, because next year that business, ideally is going to be generating revenue and profitable. And so when we review a loan, I'm actually the one reviewing the loan, right? Or my loan analyst or our underwriter. And we're not putting it into it's not like a mortgage where you kind of type in numbers and it spits out a yes or a no. Yeah. We're not black or white. There's a lot of gray. And so as a business owner, it's best to bring up, anything that you can as relates to the growth of your business or what you see, because we can, add back non-recurring expenses. Maybe you had a consultant come in 1 year and you paid him $50,000. And after that, you're not using the consultant, that's not a recurring expense. So I'm going to add that back to cash flow. But because we are hands-on in our analysis of these loans, somebody can always bring up, peculiarities in their business, because every single business is going to be different. I can eyeball a heating and air company and a plumbing company and say, hey, like your net income's at 80%. There's some type of fraud going on.
Yeah. Something's not right here, or we're going to have to look at these numbers.
Exactly. But like everybody's different. So it's very helpful to bring stuff up, because I can look at the financials and I can eyeball it, but there's a lot of story that goes into it. So whether we might be able to do the loan, but we might not, but it still allows us to paint a better target to aim for.
So quick question, because I have a couple buddies of mine and we've talked about this before, and every time we talk about it, I'm over here, Mr. Google, like, what does this mean? And one of the things is EBITDA. What does it mean, like in layman's terms? Before, like, I can see, like I Googled it and it's like, yeah, okay, I get that. But whenever I was talking to Patrick and I was talking to Elliot 2 weeks ago, we were talking EBITDA and like 3 times EBITDA, 2 times, that kind of stuff. But
yeah,
people oftentimes are like, yeah, it's a buzzword. I understand that. I see it, I hear it, but I don't have a clue what it is.
Yeah, so that's a great question. And I always, whenever I have to put it in layman's terms, which is how I think about it, to be honest, I'm not thinking about it in a complex manner. Is when I came to the bank, they were teaching us about, what is used to repay a loan, right? And so EBITDA, in my mind, is a big ball of cash. And we look at it on an annual basis. It's a big ball of cash that can be used to repay the proposed debt or any existing debt. And what goes into that is essentially the cash flow after you've paid all your expenses throughout the year. There's an amount of cash left over that can be used to pay debt. And that's what EBITDA is. And so that's going to be a combination of net income. And normally we're adding back interest expense, because if you're looking to buy a business, normally you're going to buy the assets of that company and the debt of that business goes away. So any interest that they were paying is now going to be cash available to you to repay your loan. And then things like depreciation and amortization are just really accounting items. So if you buy a backhoe 1 year and it's worth $100,000 and each year you depreciate at $10,000, that's really a cash item, right? Shields your taxes, but it's not actually, or non-cash, it's actually not cash out the door. Right. So that's cash you can use to repay a loan. And we combine that all together to come up with that EBITDA number. So whatever it is on an annual basis. So if your EBITDA is $200,000, you essentially have $200,000 that you can use to repay debt. Mm-hmm. Now, we normally, as a bank, we don't look at it from a break even. So if your annual debt service is $100,000, we want to make sure your EBITDA is at least $125,000.
Okay.
So that you're able to make your debt payment, but then you have $25,000. You have a cushion so that if next year is a little rougher and it goes down a little bit, you're still going to be above break even, but it gives you that cash left over to repay the loan. And then everybody talks about multiples because a lot of times when you go to buy a business, it's going to be a 3 times multiple, right? So if you are, because that EBITDA is what's used to, one, repay any debt you take out to buy the business, or if you buy with cash, that's going to be your return, right? So that's your distribution to yourself. Like as the business owner, you can either reinvest it in the business or distribute to yourself, but it's essentially the free cash flow after expenses that you can do with it as you please. So a lot of times the businesses will trade, and Patrick's got a better idea of the multiple, but they'll trade off of that multiple because that's what's used to repay a loan. So from my perspective, when we're giving an SBA loan, if you're a heating and air company buying another heating and air company, we can provide you 100% financing. So that multiple has to be within reason. It can't be 100 times multiple, because if I give you a loan, that business is going to be able to repay the loan.
Gotcha. Okay. And whenever you are looking at a loan to purchase, like say company A wants to purchase company B, does the company that's being purchased, does their net income have to be able to cover the payment, or does company A's net income have to be able to cover company B's payment?
That's an excellent question. So the way we look at it is, well, first, company A being the buyer. First, we'll look at company A. We want to make sure that company A can repay their current debts without any support, that it provides a good foundation for growth. Because what we don't want to do is provide financing for somebody to get out of a problem, if that makes sense. We want to have a good base for the buyer. And then when we provide financing for company B, we really want company B to be able to repay the loan. We don't want cash flow from company A having to supplement the cash flow from company B to the selling company to repay the loan, because then you're probably overpaying for it, right? So that business can't repay the debt, so I have to take cash flow out of my current company to repay it. That's not what we want. The only time you really we want to incorporate that into our financial analysis as a bank is if you're saying, okay, this guy who's he's really run this company into the ground, but there's a ton of value here. Gotcha. Once I buy
like 100,000 people on a client list or something like that that's untapped.
Yeah, and he's only been doing repair and service. And once I get in, within 6 months, I'll do a bunch of replacements and make my money back,
That makes sense.
Really quickly. We might be able to incorporate that. But ultimately, when you're buying a company and it's priced fairly, that company should be able to repay the debt. So essentially, if company A is buying company B needs to be able to repay the loan without any help from company A.
Okay, perfect. That helps out a lot. So Brian, a buddy of mine, Brian Judson, he's actually on a couple of boards with me at locally here in Savannah, but he actually asked on our Facebook Live feed, does your bank go beyond EBITDA and factor in other discretionary add backs? Family members on the payroll who are not active in the business is a good example of that.
That is another excellent question. We
Good job,
do,
Brian.
Yeah, that's a great question. You guys are on a roll, but somebody might have a daughter they pay $20,000 to, and she's 19 and goes to college. We'll add that back to cash flow, because as the new owner of a business, I'd hope you're not going to continue to pay her $20,000, right? That's going to be $20,000 that can go towards repaying the loan or reinvesting in the business. So we do, discretionary things like that. We do add back, RV payments, country club payments, stuff like that. We'll add back to cash flow, because ultimately that will be used to service any debt taken out to buy the company. Will be used to reinvest in the business. And I'll be honest, as a small business lender, you can see some crazy things being run through
I can only imagine the things that you've seen come across your desk.
Yeah, airplanes, all types of stuff.
How many times do you, or is this common, or if it is, and what's typically your kind of response to it when someone is like a last minute, like someone died, they have to sell the company. And I hate to be morbid, but that's typically what I think of whenever it's an emergency sale of a business.
Yeah.
And their books aren't really in order, but it's not a bad business. It's just their books don't really make sense. Or maybe their books have been adjusted so that they can take the best way to say this, they can take the advantage of tax incentives or rebates to the best of their abilities. How does that conversation happen? It's like, yeah, we show $180,000 loss, but in reality, we really had a little nest egg that's over here, that type stuff.
So similar to Brian's question in the live chat, that would be So that's discretionary,
Okay.
right? From our perspective, we'll have to see verification. You can't just say, yeah, I spent $60,000 at Taco Bell this year and provide no verification of it because we want to verify it because we want to make sure you as the buyer, your investment is protected, right? Because it's an investment. And so we will verify, but I mean, it is common for us to, I've seen some, where their net income is 0.1%, but the business, if you add everything back, it's like a, 20% margin, but then you're paying taxes on, like, I get it. Look, we don't contend with you, but, we have to verify all of that for our borrower to make sure, it's a good,
How about
loan
the
to make.
opposite? Have you seen it where the buyer has that instead of, and the seller is is solid?
I always think about that because it's really not something we see commonly. And I think a lot of times what happens is because people will get in growth mode and they kind of know they have to show as much as they need to. And I very rarely, and you also don't want to, if you go to your bank as a borrower and say, I've been running my uncle's car through the business,
right.
We're going to say, okay, well, you're kind of, that's not a great thing to tell somebody.
Exactly.
But honestly, like I've never had it come up from a business looking to acquire another company. Yeah. It's never the buyer, and normally the buyer's cash flow is strong, and the seller's company is where you kind of have to verify those add backs.
Yeah, that's me. If I can think of if there's going to be a weird question to ask, it's going to come from me. So I appreciate that.
This is a good question.
So Patrick, actually, he's on the live chat, and he was touting your just being an amazing resource. He says Brandon's an incredible resource for those who are looking to acquire a service business, and I agree 100%.
Thank you very much. And Patrick, and the same can be said for Patrick. He does an excellent job in getting the deal done. I think oftentimes, when you hire a broker, you want to get somebody in Patrick's position, you want to get the deal done, and Patrick gets the deal done because he's realistic. He's incredibly communicative and great at communicating with both buyer, seller, and us, and really helps get the deal across the line and allows sellers to exit the business and get value for what they've, spent years building. So,
yeah, that's cool, man. Is there anything that I forgot to ask, or because time flies whenever I'm having conversations with guys like you? Is there anything that I didn't ask? And if not, where do we learn more about you and connect?
Yeah. So I think the only one thing I'd add is for the listeners is if it's your first time thinking about getting an SBA loan, there's three big things we look at. The first thing is going to be business cash flow. Because the loan is government guaranteed, you're not dealing with the SBA though. You're getting a loan from Live Oak, but we're looking at the cash flow of the business. Can it repay the debt? And it's not collateral based, which means if you're looking to get $1 million loan to buy another business, it does not have to have $1 million in collateral to fully secure the loan. That's not going to keep you from getting approved. Then we're also going to look at resume. Obviously, you're already the owner of a heating and air company, so that box is checked. And third, and even though it's a business loan, we do require personal guarantee as an SBA loan. And so we do look at personal credit. That's a big important thing. So those are kind of the three things to consider when seeking an SBA loan to grow your business.
So with the personal credit, what's the personal credit score have to be?
It'll vary by bank. Typically we're looking at, 660 and above, but it's not a automated process either. So sometimes, just like with a business, there can be an explanation there as well.
Gotcha. Cool, man. Yeah, I appreciate that. This is all great, amazing stuff. Where can people connect with you and learn even more, or go ahead and get the process started in purchasing?
Yeah, Teresa, I appreciate that. And so for my contact information, my email is Brandon, BRANDON.Bolin@liveoak.bank, or you can call my office line, which is 910-550-2858. And you can also visit our website at liveoakbank.com, and we have a page where you can contact either myself or our loan analyst, Dylan, to get the process started. And even if it's just an idea you have, or you want to get your business pre-qualified to acquire another company or to buy real estate, but you don't yet have a target in mind, we're happy to have that conversation. I don't charge by the hour, or at all for that type of conversation. So I'm happy to speak, 24/7 with somebody, and really appreciate the opportunity to be on today's podcast and to get to talk with you, Tersh.
Yeah, man, I appreciate it. 100%. And I'm glad you actually mentioned that at the end. I completely forgot to ask. So we can reach out to you and say, hey, look, I'd like to get pre-qualified. Can you say, how much can I get? Or would we need to come to you and say, hey, I'm looking at getting a $200,000 loan for purchasing a company. Am I pre-qualified?
Yeah. So when you're looking to acquire another business, I can essentially look at your current business and let you know if it provides a good foundation for growth. It's kind of hard to say, hey, you qualify for X amount, since the loan will be based on the business you're buying.
Okay.
But if you're looking to buy real estate, we have a customer you got two properties. He's got one that's worth $1.5 million and one that's worth $3.5 million. And he wants to know, does he qualify for both or just the $1.5 million? So I can look at his business and say, okay, you qualify for the $3.5 million building as well as the 1.5, or you qualify for X amount. We can do that for real estate.
Sweet, man. Cool. I appreciate that. And I appreciate Brian and Patrick and their what they've brought to the table as well. Brian, he's a great local broker here doing amazing things. And Patrick, everybody in the HVAC industry kind of knows Patrick. And he's doing amazing things with his videos and everything else. But yeah, thank you again, Brandon, for coming on the show. And I'm honored to be connected with you and the group over at Live Oak. And I look forward to the day whenever we get to write Live Oak a check.
Absolutely, Tersh. I appreciate it.
Yeah. So everybody have a wonderful day. If you have any questions for Brandon, I'll put his information in the show notes, but also, don't hesitate to reach out to me, connect with me on social media. At Tersh Blissa is my at me. And until we talk again next time, have a wonderful week and stay safe out there.
Thank you for listening to this episode of Service Business Mastery. Now that you are equipped with essential business advice from this impactful conversation, you are one step closer to becoming the successful owner of your dreams. If this episode has been helpful to your business journey, don't forget to subscribe to the show, leave a rating, and share it with other owners as well. Visit servicebusinessmastery.com to learn more.